Good afternoon, everyone. This is Joe Bacella, webinar organizer here at Chaikin Analytics, and I'd like to welcome you to our presentation of looking for consistent cash using income strategies with covered calls. Presenting today is Mark Chaikin, founder and CEO of Chaikin Analytics, along with Tony Zhang, co-founder of Options Play. Throughout the webinar, please submit your questions using the Q&A window, which is available in the upper left-hand corner of your screen. As a reminder, this webinar is being recorded and a copy will be sent to everyone who has registered. Now, Mark Chaikin created Chaikin Analytics to put the power of proven research tools in the hands of professional and individual investors. His latest contribution, the Chaikin Power Gauge Rating, is a proven 20-factor model that uniquely combines fundamentals and technicals. To show us how it can be used to find great stocks and ETFs for income strategies, here's Mark Chaikin.
Thank you, Joe, and welcome everybody. In this afternoon's webinar with my guest webinar presenter, Tony Zhang, we're going to be looking at option income strategies using covered calls, but we're also going to show you how to protect portfolios against a bear market and also how to find opportunistic, speculative buying opportunities during earnings season. So in the next 45 minutes, we're going to go through my checklist for supercharged options profits, which does include finding attractive covered call rights. A little bit of my background. Been on Wall Street for 50 years. I've been using technical analysis for 45 years, but always in conjunction with fundamental analysis. And that's what our Chaikin Power Gauge Rating, which we're going to talk about in the beginning of the webinar, really does. It does the fundamental heavy lifting for you so that when you're developing option strategies, you can use a combination of fundamentals and technicals to zero in on those stocks that are most appropriate for the particular strategy that you're using. I did head up an options department for 5 years at a fine regional firm called Tucker Anthony and R.L. Day. Over 250 brokers, tens of thousands of options trading clients. And there's an interesting statistic out of that. 95% of those options traders lost money. They were either making a wild, out of the money, short duration bets, or they just didn't have the right tools to properly make money in the options market, and very few of them were focusing on options writing. A few of the institutional clients, some of the big banks in New York City, had option writing programs. Now, along the way, I've been mentored by some of the smartest and most successful institutional investors. Some of them were colleagues, some of them were clients at fine institutional firms like Fidelity and T. Rowe Price and General Motors Pension Fund. And the reason that's important, because everything I learned from them when I was teaching them how to use technical analysis in their decision-making process, I had to get to know what they did, what they looked at, how they made decisions. That's all reflected in the Chaikin Power Gauge Rating, our multi-factor model that analyzes the fundamentals of 5,000 US equities and 1,500 ETFs. It's really the culmination of my life's work, and I'm very pleased to be able to share that with you. Now, our co-webinar presenter today is Tony Zhang. He's going to introduce himself, but I will tell you that Tony and his associates have done some very interesting research that he's going to share with us later on in the webinar about the ideal candidates for covered call writing. So with that, Tony, why don't you take the mic and introduce yourself?
Thank you, Mark. Thanks everyone for having me here today. Excited to give you guys an introduction about what Options Play does, but also the research that we've been doing. So just a little bit about myself. I run the product team here at Options Play. So we designed this platform from the ground up. We started this company about 4.5 years ago, really to help everyone change the way you view options. Looking for option strategies, whether you're looking for bullish, bearish, or even income strategies, is a tedious and time-consuming task. So that's really what Options Play, or why we created this platform, is to let you guys very quickly, regardless of whatever views you have in the market, to instantly find bullish, bearish, and even income strategies that are available to you on any given stock. And that's what we're going to show you today. A little background about myself. I came from a trading background on the FX side and have spent a lot of years, following the markets using technical analysis, fundamental analysis, and eventually trading FX options. And that's really how I got my start with trading options. And spending a lot of time trading different platforms, looking at different tools that are there to help traders decide what to buy and sell. That's when I realized that there really was a gap when it came to how do you quickly find option strategies on any underlying stock. And that's why we created this product. And that's what we're going to show you today. And specifically, what we have some research on is we've done a lot of back testing over the last 10 years on what is the right cover call to sell, because that's usually the question that we get asked the most. What expiration should I choose? What strike price? And we have some insight into that, and that's what we're going to share with you later today.
Thank you, Tony. And as we get into the webinar, I think it's important to realize that Chaikin Analytics was created for individual investors, but it's now being used by our old professional clients. And we've gotten some great media coverage, including a nice article in the current issue of Forbes about Mexico, where we analyzed the Mexican ETF in a little carve out. And just a couple of months ago, we received what we consider to be the highest praise from Benzinga, news site on the internet that sponsors FinTech Awards. For the last 3 years, we won the Benzinga FinTech Award for Best Ideas Platform with 20 other people in that category. The Chaikin platform, which we're going to use to show you some of the examples, has beaten them all, really, and we're very pleased about that. Now, I'd like to start out, especially since we had a pretty negative day in the market. We're back down to levels that we haven't seen since May, to ask you this question. Are you thinking about a bear market? Is a bear market built into your strategies, or is it stopping you from trading? If you are thinking about a bear market, please type a big B into the question box. And Joe, if you just let me know sort of what you're seeing there in terms of response, that'll give me a little bit of a flavor for what the audience mentality is.
Let's see, I'm seeing a few B's initially come through, and here comes a lot more. Looks like everybody was typing in at the same time. I'm seeing a few dozen B's coming through.
Well, that's not surprising because we've been in an 8-year bull market. If you read our weekly market insights, because we have some subscribers on the line, you know that we're still bullish, but we haven't had a 5% correction since last July, so we're long overdue for a bit of a pullback. But let's take a look at the two major markets here. The S&P 500, the large cap market. This is the SPDR, the ETF that is the most actively traded instrument in the US markets. And as you see, we've been in a very nice uptrend channel. Now the market finished down close to 0.9%, so we're right at the bottom of that channel. But Chaikin Money Flow has remained strong through this 2.5-week pullback, and we're still holding that uptrend channel. And Chaikin Money Flow, as most of you know from your online brokerage platforms, measures institutional buying and selling. It's also available on stockcharts.com. And based on how Chaikin Money Flow has reacted during this market, we think that we'll probably hold support levels at 2390 to 2410. But when you look at the Nasdaq 100, the triple Qs, totally different picture. And the reason is that tech stocks have broken down. Even though the S&P 500 was dominated for the first 6 months of the year by the FANG stocks plus Apple and Microsoft, which accounted for almost 40% of the gain in the S&P, the Nasdaq 100 has been powered by tech stocks and biotech, specifically semiconductor and other high energy tech stocks with good earnings, by the way. This is not 2000, in my opinion. We're not in an earnings bubble, or an internet bubble rather. So what I've done here is I free-handed a head and shoulders pattern. As those of you know who follow my colleague John Schlitz and his morning insights, head and shoulder patterns are very predictive. And 4 trading days ago, we broke below that lower neckline on a head and shoulders pattern. And today we accelerated to the downside. So the triple Qs are clearly in a pattern of having broken the head and shoulders neckline, and also you've got a series of lower highs and lower lows. So this is part of the market that's likely to underperform. I don't think we're heading into a bear market, but the triple Qs are likely to underperform. But let's say you're concerned about a July-August decline. Well, in a decline, you want to use put options to try and profit or protect your portfolio. So we put up two examples derived from the options play module that Tony Zhang created. On the left are three possibilities for playing the downside in the S&P 500 and the SPDR ETF. You could either short the ETF, cost you $24,000. You could buy a put option, in this case with the index at 241.59 this afternoon, suggesting the August 242 put that expires on August 18th. And then a more attractive alternative, a vertical put spread. And most of the time, Tony, and I think you can weigh in on this, the vertical put spread has a higher risk reward ratio and therefore is rated more highly by options play.
Yeah, absolutely. So right now, being the VIX as being such a low, VIX being so low, it's actually quite cheap to buy protection on the S&P 500. As you can see, it only costs you $180 to hedge effectively what is 100 shares, which currently costs $24,000. That's less than 0.7% of the underlying shares to buy some downside protection for about a month and a half in S&P. It's a little bit more expensive on the Qs. It's about 1.5% of the underlying shares, $212 to buy, a 1.5 month downside protection. Both the S&P and the Qs are trading right near their major support levels. So if you do see them break below that, this could certainly be a cheap way to buy some downside protection.
And that 344% return basically is predicated on a 3.5% drop in the next 5 weeks, which is entirely consistent with maintaining a bullish outlook on the market, but that mildly bearish shorter-term trend that we looked at. So just an example of how options play, which is built into Chaikin Analytics, quickly and easily focuses you on the best ranked highest probability options trades. And in this case, the vertical put and call spreads to play the down and the upside almost always come out ahead. So again, going back to that Tucker Anthony analogy where 95% of traders lose money, they do it by making wild bets, almost moonshots, whereas options play points you in the direction of high probability strategies. Now, as Tony so aptly pointed out, finding option strategies, particularly buy rights, and knowing which strike price and expiration to choose and which stocks to choose really requires an awful lot of concentration because there's so much information. And that's really endemic of one of the problems that we all face in investing and in our personal lives, information overload. Facebook, Snapchat, Twitter, LinkedIn, email, and in the options area, the options chains and all the information that you can get on Google Finance or Yahoo Finance or CNBC. So to make money in the markets, particularly in options, which move so quickly and have so many different variables, the key is how you focus in the age of distraction. That's right at the center of this chart. I know Joe Bicella, who's in touch with so many of our clients on a daily basis with his orientation sessions and his pre-market sessions, told me a couple of months ago that one of our clients said that this is his favorite slide. He's taken a picture of it and put it in his trading room because it really is indicative of the problem we all face, how you focus, because to make money in the markets, you need a focus. So our solution to the information overload problem is Chaikin Analytics, which incorporates options play. This is an example of the options play screen. Tony, we're not going to do a live demo of options play today, so why don't you quickly walk people through the screen and the various panels, just highlighting what you think are the most important aspects.
Yeah, so as you can see on the panel here on the right, for any symbol that you type in, you click on options play, it'll launch a widget that gives you three options. You can click on I'm bullish, I'm bearish, or looking for income. And it will always present three strategies to you that are relevant for those outlooks, so that you don't have to go searching for which calls should I buy, which spread should I do. It already presents them to you, and it presents the three side by side, so you can make that comparison between buying a stock and buying a call, which is usually the most common comparison you will make when you're trying to decide if you should trade the underlying stock or trade an option strategy. And for those of you that are a bit more advanced, you might want to compare buying a single leg strategy versus a multi leg strategy. We present these three strategies side by side and provide you four interactive panels to help you fine tune each strategy, such as a P&L simulator, trading range simulator, and also ways to calculate the appropriate number of contracts. And if you ever want to modify any of these strategies into more complex strategies, so we have about 45 different option strategies that are supported by this, that you can create and compare them side by side. So if you do want to get into the more advanced strategies like butterflies and condors, you can create put condors versus call condors and put them side by side and really make apples to apples comparison. And we have the options play score, which gives you a true risk to reward metric that allows you to compare any two strategies side by side and see which one's actually best suited for you.
And the reason I like options play and the reason we integrated it almost 2 years ago into Chaikin Analytics is because if I were building an options idea module, this is the one I would have built, and it would have taken us a long time. Not sure we would have gotten it right. And options play has certainly hit the ball out of the park, and they've got a number of institutional clients like Merrill Edge, Raymond James, and Oppenheimer to prove that. So how does Chaikin Analytics help options traders? Well, we give you what was lacking from those tens of thousands of traders at Tucker Anthony, a directional edge. Most options traders, and this also applies to option writing, as you'll see, don't understand the importance of a directional edge. We give you that by combining fundamentals with technicals into a quantitative model and then providing buy and sell signals for better exits and entries. And exits and entries, as you know, are extremely important, not just in speculative trades like put spreads or outright put call purchases, but in timing the initiation of a buy right position. So if focus is important, discipline is the other side of the focus coin. Successful trading demands a disciplined methodology. This pyramid encapsulates what we believe at Chaikin to be a very simple but powerful discipline methodology. It starts at the top with the Chaikin power gauge rating, your directional edge. And we also like to look at industry and sector strength because there are trends. For instance, energy's in a bear market right now, or at least feeling like it's in a bear market, whereas technology, financials, and healthcare are in a bull market. So you want to look for positive opportunities in the sectors and industry groups that are looking strong, and I'll modify that a little bit by saying technology is breaking down, as we saw by the triple Qs, but has been in a bull market with some phenomenal opportunities, as we'll see in a minute. The bottom, just two technical indicators. Remember when I started, I said that for 45 years I've been using technicals in conjunction with fundamentals. The problem was analyzing the fundamentals was very time consuming. I wasn't a trained MBA or Wall Street analyst. But I learned enough in 40 years to build the Chaikin power gauge rating, which is 85% fundamental. And you're going to see the factors in the model in a minute after we show you some examples of bullish and bearish patterns that we think are really important. So let's start out by looking at a pattern we call classic Chaikin bulls. Power gauge rating is bullish. The stock is outperforming the market. How many of you are familiar with the concept of relative strength? Not Wells Wilder's relative strength, but how a stock is doing relative to the market. If you are familiar with this concept, please type a big RS into the question box. And by the way, if you get your relative strength from Investors Business Daily, just type a big I after the RS, because we want to sort of gauge where people are getting their information. because we've got new products coming out and we'd like to target some of the traditional information sources because we think we can improve on them. So Joe, what are we seeing in there? It's almost like a live poll that you've got the window into.
Seeing a lot of RSs, not too many I's though. I saw actually somebody say just a big capital NO, I think when you mentioned IBD, but it looks like a lot more RSs than I's.
Yeah, and I understand the reason for the NO, information overload, all those numbers, complicated charts. When we started Chaikin Analytics, one of our target competitors was Investors Business Daily, the charts and the services there, because we thought we could improve on that. And then the third piece of the Chaikin Classic Bull is strong Chaikin money flow. We want the institutions to be buying along with us. So here's an example, AMAT, Applied Materials, manufactures equipment for the semiconductor industry. At the bottom of this one-year chart from Chaikin Analytics, the Chaikin power gauge rating as a ribbon that goes from red to yellow to green, depending on whether gauge is bearish or bullish. Notice there's been no red, although we've recently turned yellow, meaning that the power gauge rating is neutral. The underlying fundamentals are still bullish, but the stock is now in a downtrend. Looks very similar to the triple Qs, doesn't it? Lower highs and lower lows, but it was up today. So both Applied Materials and Lam Research, which have been big favorites of ours, were actually up today because there's some bottom fishing going on. And even with the market selling off an additional 0.5% after I drew these charts, both those stocks finished slightly higher on the day and a big sharp down day. So this is a classic Chaikin bull. Power gauge is bullish. That's your directional edge. Relative strength, we've converted all those numbers in Investors Business Daily into a heat map. And in this case, AMAT is all green because the stock has been outperforming the market for 15 months. And along the way, Chaikin Money Flow has indicated big institutional buying. Notice how Chaikin Money Flow normally fluctuates around the zero line, goes from green or accumulation to red to distribution. That's normal behavior. What's not normal and a very, very powerful indicator is when Chaikin Money Flow stays positive for long periods of time, in this case 5 months, even when the stock like AMAT corrected back here in the April-May time framework, March-April time framework. Chaikin Money Flow stayed green or positive. We call that persistent accumulation, stealth buying, and it's a tip-off that the institutions are not contributing to the sell-off, they're actually taking advantage of it. So you want to be there with them. And that's what these buy signals are all about. 6 pairs of buy and sell signals in Chaikin. This is our oversold buy signal. Now, all of the signals in Chaikin are available on our website, the descriptions of them, so that whether you're a guest or a subscriber, you can see what these signals are made of. You can see the logic behind them. And in this case, the oversold buy signal is a very simple pattern. It's a stock that has a bullish power gauge rating, so the fundamentals are in your favor. That's your directional edge. That's gotten oversold and made a new 8-day low. Really simple. I owe this pattern to Larry Williams, who's been a sort of long-distance mentor to me. I based my Chaikin Money Flow on research that Larry Williams had done in the late 60s on accumulation and distribution. And then final piece of the puzzle here, all on one chart, we've color-coded each of the 4 quarterly earnings reports. In this case, they're all green. They could be red if the company had disappointed. In this case, AMAT, which is due to report in August, has had positive earnings surprises for at least the last 4 quarters, and that would be true going back for almost 3 years. Now let's look at a screen that enables you to find these stocks. It's very nice to know that there's a classic bullish pattern, but you have to be able to find them. So there's a screener built into Chaikin Analytics, and I know there are a lot of other screeners available on the internet, but this is the only screener that combines a powerful predictive quantitative model called the Chaikin Power Gauge into the screening criteria and enables you to screen on any of the 20 factors in the model, in addition to the other technical factors that typically show up in a screener. So FinViz has a great screener. I don't know if Yahoo still has their screener, but this is very, very focused around our core strength, the Chaikin power gauge rating, and the two technical indicators, money flow and relative strength. So in this screen, I just look for very bullish stocks in the Russell 3000 in the Chaikin power gauge model with strong money flow and relative strength in the large and mid cap size group. And then I added one other factor, earnings surprise, very important, as we'll see in a minute. I want companies that have beat analyst estimates consistently. So this screen was done about a week ago for a webinar that I did. And we narrowed the Russell 3000 down to only 17 stocks, including stocks like KB Homes, Activision Blizzard, Electronic Arts, Allstate, Anthem Health. Very diverse group. Some drug stocks in there, some insurance stocks, some healthcare stocks. But look how easy it is to narrow down the big universe, to focus and cut through the clutter and the information overload. So now let's look at the classic bear patterns. Just flip the bulls on their head. Power gauge rating is bearish, indicating that the fundamentals are skewed against. Stock is underperforming the market, and Chaikin Money Flow is red, not green, telling you the institutions are selling the stock. So we've been using Under Armour as our poster child for a classic bear for about 9 months. And guess what happened to the stock today? It was down about 8%. So look at the power gauge at the bottom. Again, your directional edge. Bearish starting in July of 2016. The stock was in the 40s on its way to 18. Underperforming the market. Now the relative strength heat map is red, not green. We make it really visual and simple. And along the way, the institutions were selling the bejesus out of the stock, and there were signals. In this case, our relative strength sell signal. So let me explain that one to you, because this one is really powerful for options traders, whereas the oversold buy signals and overbought sell signals are great for short-term option trading or swing trading. They have a duration of about 5 to 10 days, meaning that that's their maximum efficacy. On the other hand, the relative strength signal has a duration of 4 to 8 weeks. Makes it really attractive for swing trading, gives you the ability to buy in the money options with a longer duration, so cut down on the time decay. That's a really simple pattern. Doesn't care about the power gauge rating like the overbought sell signals or oversold buy signals, but it works best if the power gauge rating agrees, so that the market agrees with the model. So you have bearish relative strength, meaning the stock is underperforming the market. The stock rallies above its 21-day average, which is the center line here on the chart, and then drops back below the 21-day average. So now that's an indication that the rally is over. These signals work 70% of the time. The money flow signals that you'll see and the overbought, oversold signals work about 66% of the time. So this is highly reliable and goes out 4 to 8 weeks. And even though money flow was strong, because there are bottom fishers in the apparel group, Under Armour was down almost 8% today, with LB Brands down significantly. Very steep declines because the power gauge is still bearish and the stock is underperforming the market. So what is the Chaikin power gauge rating? Well, first and foremost, it's a reliable indication of a stock's potential to outperform or underperform the market over the next 3 to 6 months and beyond. The display is very simple. Looks like the gas gauge on your car, but please don't confuse simple with simplistic, because under the surface there's a lot going on. We're crunching a lot of numbers for you. And the Chaikin power gauge rating can be your GPS during earnings season. So even though Tony's going to devote a good chunk of the segment to covered call strategies, we're going to also show you how to use Chaikin Analytics, the power gauge, and options play during earnings season to make outsized profits with limited risk. So John Carter, who's probably one of the best traders in America, has a company called Simpler Trading, as a partner of Chaikin with a trading room and options and futures guru and a stock analytics expert, creates technical indicators. Got exposed to the Chaikin power gauge about 1.5 years ago. and did a lot of research and said, this is really an awesome meter for stocks. There are a lot of hyped up tools out there, but when I find something interesting, I'll let you know about it. And he was talking to his trading community. You can imagine that a single tool that combines 20 plus technical and fundamental indicators, and I'll stress fundamental, so you'll see in a minute, to anticipate a stock's profit potential got my attention. It's called the Chaikin Power Gauge rating. At a first glance, I thought this looked like an objective, awesome meter for stocks. And I like the fact that it includes fundamental and technical indicators for stock selection and timing. So what were those 20 factors that got John Carter so excited? Well, we analyzed financials, earnings, technicals, and expert opinions. Now you notice I've got the boxes in red already pre-positioned. I've taken a lot of heat here internally that I don't know how to do a PowerPoint presentation. Well, there's a method to my madness. I want you to realize that there's something special we're going to zero in on here in a minute, because within each of these 4 primary factors, we've got 5 inputs or subfactors, 20 factors in all. Now this is on the left, a power gauge rating for Lam Research, which along with Applied Materials has been leading the tech stocks higher just until about 3 weeks ago. And the power gauge on March 27th was 127. The stock peaked at around 167. Pretty hefty move because it started out bullish at about 80. So what are these 20 factors and how do they help you? Well, 35% of the model are these value metrics that we call financials that a Warren Buffett or a Seth Klarman will look at. Now, not many of you know Seth Klarman. I'm not even going to ask you the question because we've done this before, but he's become better known because his horse won the Preakness in May. So Seth Klarman is probably the most successful value investor, building on the same Graham and Dodd principles that made Warren Buffett successful. And they look at free cash flow and price to sales ratios, those value metrics that really predict the financial strength of a company. But we also zero in on shorter term factors, which is what makes the power gauge rating so powerful for options traders as well as intermediate term investors. One of the factors we look at is earnings surprise, and we're heading into earnings season. Beginning next week, companies are going to start reporting second quarter earnings reports. The banks report the end of next week. So earnings season begins in earnest mid-week, and on Friday next week, the major banks, which we're very bullish on, will report earnings. So earnings surprise is so important because companies that beat analyst estimates tend to do it over and over and over again. This is what I learned from one of my mentors, George Douglas, at Drexel Burnham in the mid-'80s. He did the original research on earnings surprise and analyst earnings estimate revisions. And what George taught me was that earnings surprises come in bunches. And they lead analysts to raise their earnings estimates, or in the case of negative earnings surprises, to lower their estimates. And earnings estimate revisions are the biggest input to short-term stock price movements. Academic studies have proven this. Now, even though we keep reading about high-frequency trading and how the markets are changed, things are the same now as when I started on Wall Street 50 years ago. If a company reports a positive earnings surprise and a key analyst at a firm like Goldman Sachs or Morgan Stanley or Merrill Lynch raises his estimates, the salesman at that firm will call their best institutional clients. What are they doing? They're looking for an order. And so they do something known as pounding the table. They'll promote that analyst's positive or negative downgrade. Now, we saw that just a few days ago in Tesla, where the Goldman Sachs analyst said he saw 50% risk in Tesla. Now, what do you think the Goldman Sachs salesmen are doing when they get that high quality piece of research? They're calling their best institutional clients, encouraging them to sell Tesla if they own it, or if it's a hedge fund, to go short. So we've got shorter term factors in here, like earnings surprise and earnings estimate revisions. which is why this robust model has worked so well in the 6 years plus that it's been readily available. And we'll see the performance of the model in a minute. And then we also have insider buying and industry group relative strength. As we said, industry group trends are very important because they tend to affect all the companies in a group, not just one or two of them. So what have been the power gauge results? Well, in 2016, the very bullish stocks using the Russell 3000 as a universe were up 32%. And we're not cherry picking here. Each of these silos is equally populated, 428 very bullish stocks at any given point in time. On the other hand, in 16, which was a nice up year for the market, the very bearish stocks were up, but they were up only 9.5%. So the question you need to ask yourself is, do you want to play on the long side in the stocks that are likely to be up 32% in a bull market, or the stocks that are only likely to be up 9.5%? Well, here's the answer to that one, because 2015 saw a bear market in energy stocks, as we'll see in a moment, and in small caps, so that the very bearish stocks in the Russell 3000 were down 17+%. That's where you wanted to be fishing on the short side with puts, and where you didn't want to be bottom fishing. The very bullish stocks were flat with the market down only 1%. It's that spread between very bullish and very bearish that gives you that directional edge. Now, one final proof point before we get into some really meaty examples and Tony's options covered call writing research. 3 years ago, we partnered with Nasdaq and created 3 co-branded Nasdaq Chaikin indices: large cap, small cap, and dividend achiever. The goal was to take the Chaikin power gauge methodology, that disciplined triangle that we talked about in the beginning, and apply it to the Nasdaq 300, 1500, and dividend achiever index to create sub-indexes, and they're called the Nasdaq Chaikin large cap, small cap, and dividend achiever index. The goal was to create a long-term track record on passively managed indexes. You've been reading a lot about that lately. These Nasdaq master indexes are rebalanced just once a year. So the Nasdaq Chaikin indexes can't be trading oriented. They've got to find the best stocks because they're going to be held for 1 year till the next reconstitution. So we built a 3-year track record and achieved our goal that New York Life's Index IQ subsidiary has licensed all 3 indexes, registered them with the SEC as ETFs, and on May 22nd, they launched the first of the 3, the Index IQ Chaikin Small Cap ETF. It's already garnered $115 million in just 6 weeks. It's the 3rd most successful ETF launch in terms of assets in 2017. There have been over 85 ETFs launched. Now, this is not meant to be a recommendation to buy this small cap ETF, just using it as an example of how the power gauge rating has gone from bottom-up stock picking tool to a top-down portfolio creation methodology that's now being licensed by the largest mutual insurance company in America. Manages $700 billion in their separate investment management subsidiary. So enough of the promotion. The reason I do this is I want you to walk away from this webinar with the confidence that there is a disciplined approach to fundamental analysis that can help you become a better, more profitable options trader. Now, I'd like to zero in on a couple of patterns and then turn it over to Tony. The first pattern is the dynamic duo. It's the combination of the Chaikin power gauge rating and Chaikin relative strength that you saw in the classic bull pattern. And we call it the dynamic duo because it finds big winners and losers. And superior returns come from stocks that outperform the market. Now, there's one caveat. Relative strength stands alone as a bullish or bearish indicator. Now, what do I mean by that? I mean that there are certain stocks that we would call momentum stocks that don't really have the fundamentals to support the powerful up moves that you're seeing. Classic case in point is one that we're living with right now. We're going to end the webinar by analyzing it. It's Tesla. Tesla just doesn't have the fundamentals to get a bullish power gauge rating. fact, the rating has been bearish at times, but it did have very, very powerful momentum. Now, the problem with using just relative strength or price momentum is that you're on a high wire without a safety net, because the fundamentals are not supporting that up move. And when something goes wrong, you fall off that high wire, there's financial pain, and we're going to analyze Tesla because it may be happening as we speak in Tesla right now. So here's an example of the dynamic duo on the upside. WellCare, WCG, has had a bullish rating for over a year, outperforming the market, so the market agrees with the model. That's what we call the dynamic duo. And money flow has been strong with positive earnings surprises, and the buy signals have worked beautifully. The oversold buy signals on this chart, all three of them work well. You can see that sort of 2-week duration, actually a little longer in this stock, and making new highs in spite of the uncertainty in Washington over repeal and replace of the Affordable Care Act. Now, TripAdvisor is an example of the dynamic duo on the downside. Notice how Chaikin power gauge rating at the bottom has been bearish for almost a year, starting out at $60 on the way to $35, and the stock's been underperforming the market. So the sell signals have worked, and we got a sell signal coming into yesterday's price action where the stock was down. Now, TripAdvisor, as you know, is an internet-based travel and restaurant rating service. So let's go back in time. So I want to show you that the power gauge is not just working now, but it's been working for 3 or 4 years to help traders make money. So Yelp is in the same space, the same industry, internet, travel, and restaurant recommendations. And back in 2014-15, it looked almost exactly like TripAdvisor does now. Bearish power gauge rating, underperforming the market, whole series of sell signals. Where that big red arrow shows up in 2015, we put out a sell recommendation. We made Yelp our bearish stock of the week in my weekly Market Insights newsletter. And you can see what happened after a negative earnings surprise. The stock dropped from 35 all the way down to 22. And excuse me one moment. One of our new Chaikin Analytics subscribers back in July of 15 gave us this testimonial, and he gave us his trading blotter. I think that's from Interactive Brokers, but I'm not sure. Netted $17,408 profit this morning. I found more success in the past 2 weeks using Chaikin than I've had the rest of the year. Had the biggest winner of the year today on Yelp earnings based on Mark's bearish play of the week. Risked $7,168 and netted $17,408 in profit. Now, this is before we had options play built in because this was our iPad app. But Mike obviously was a sophisticated trader because he put on 3 different put positions, different expirations, different strike prices. We've simplified this now. You don't have to be Mike T to make outsized profits. But this is an example of how Chaikin Analytics has been working for the last 3.5 years since we launched our browser-based product to help options traders make money by combining earnings and options ideas during earnings season. Now, a second pattern we want to look at we call personality changes. And it's really important to be able to spot personality changes. Why? Because too many people put their feet in cement when they're trading. We fall in love with stocks, we fall out of love with them, we're slow to realize that things are changing, and putting your feet in cement on Wall Street is probably the biggest sin you can make. It's akin to letting your losses run and taking your profits, which is exactly the opposite of what the pros do. They cut their losses and they let their profits run. Part of being able to spot personality changes is to enable you to benefit when other people might be leaning the wrong way. So here's Anthem Health. Another healthcare stock that's made new highs in spite of all the confusion in Washington over healthcare. And you had a bullish personality change here in November. It's really easy to spot. Relative strength goes from red to green, indicating that the stock is outperforming the market. Usually it's associated with a breakout from a basing area, which happened in November of 2016. And the stock has gone from 130 all the way to 195 in that time period, and holding up pretty well in a correction because healthcare is a strong industry group. And you've got these nice relative strength buy signals along the way, positive earnings surprises to get Wall Street analysts excited. This whole syndrome keeps reinforcing itself. So spotting that personality change was really important because look what happened. Since November, there's only been one day with negative Chaikin money flow. The institutions had a whole change of heart about healthcare right after the Trump victory, and you can see it on this chart. Now let's look at a bearish personality change. Hertz, the car rental company, had a bearish personality change after a negative earnings surprise. The power gauge had already gone negative back in late September with the stock at around 35. Then it had a bearish earnings surprise, which shouldn't have been a surprise if you're using Chaikin because there were a series of them, and there have been a series to follow. Remember what I said, earnings surprises come in bunches. There's never just one of them. They're sort of like cockroaches, especially negative earnings surprises. So the bearish personality change came with the stock at 25, and you might have said, well, 25 down from 50, I'm not going to get bearish on this stock, but the stock bottomed out at $9. So 25 was a very good spot to start looking for put buying opportunities, or if you were stuck, to throw in the towel and say there are better places for my money. I'm going to look for one of those bullish stocks that ended up being 32% higher in 2016. So spotting personality changes is really important. And then the third pattern, and then we're going to turn it over to Tony, we call stealth buying and selling. You saw that in a number of these healthcare stocks where the institutions just kept buying it, even on dips in the market. But I'm going to show you a pattern now that we've been teaching Wall Street traders for over 30 years, because Chaikin Money Flow has been in the marketplace since 1981. We call this pattern a bearish money flow sell alert. And the example here is a stock called Advanced Auto Parts. Now, we've been bearish on auto part stocks since April, and I'm going to show you that. And if that doesn't convince you that there is a better way and that you don't need gurus or Wall Street analysts, you can do it all yourself with simple tools, nothing will. So what is a bearish money flow sell alert? It occurs when a stock makes or equals a previous high near an upper volatility band, and money flow, instead of going green, stays red. Now, why is that such a powerful signal? A, it's one of the only technical signals I know that can help you get out near a price peak with a high degree of confidence that you're not leaving too much on the table. And it indicates that the institutions are selling the strength. The smart money is exiting the stock. So that happened with Advanced Auto Parts at around 170. Negative earnings surprise, stock drops, power gauge is bearish, another negative earnings surprise preceded by an overbought sell signal. That's a new 8-day high. Sharp spike down, and look what happened to the stock. We're going to look at the auto parts stocks in a minute. But yesterday, the auto parts stocks were down between 10 and 20% in one day. But if you were using this methodology, either at 170, 160, or on the sell signal at 150 ahead of the last earnings report, you would have been shorting the stock. You would not be long. You wouldn't be in pain. You wouldn't be wondering what to do with the stock down 10 or 20% yesterday in one day, because anything you do on a day like that is going to be wrong. I can promise you that. Based on 50 years on Wall Street, if you sell the stock in a panic, that's going to be the absolute low. And if you don't sell it, guess what's going to happen? It's going to keep going down. This has happened to me over and over again until I had these tools to anticipate price moves before they happen. Now, what we've been talking about, classic bull, those three indicators lining up in the signals, is what Warren Buffett likes to call a fat pitch. He's famously said that they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. I call that the ideal setup. So we spent the first part of the webinar talking about the ideal setup, which can help you in your 401k plan. It can help you identify stocks to trade on the long or the short side with confidence. But now let's take a look after this testimonial from a subscriber, Harry S., who was trading in February of 16 using options and the Chaikin Power Gauge rating, gave us this testimonial. I'm up over $17,000 in 2 weeks. You changed my life just with my options trades on Google, Amazon, and Priceline. It's all from checking the Power Gauge rating. Chaikin Analytics is a godsend. So with that nice testimonial, Tony, I'm going to turn it over to you, and this whole section on covered calls is all yours. Just tell me when you want me to move the slides if I'm not picking up on the right time.
Thank you, Mark. Today, we're going to be talking about writing cover calls on the stocks that you find using the Chaikin Power Gauge. A lot of you are long-term buy and hold investors, so cover calls is a great way to increase the yield on the stocks that you own by selling out of the money calls and receiving some income for doing so. And you can do this for either if you intend on holding the stock for a long period of time and you're just generate some additional yield, or if it's a stock that you've held on to for a while and you're looking to get out of it, you can use cover calls as a way to potentially sell your stock at a predetermined price. So these are two ways that you can do that you can use this strategy. And Mark, you can move on to the next slide. So when it comes to selling cover calls, there's really two things that you're looking for: is expiration and strike price. Those are the two things you need to search for. And one of the questions that we get on options play is, what's the optimal expiration? What's the optimal strike price? So today, the PowerPoint here is a little screwed up here, but as you can see, we have short, medium, and long term. Short term being 20 to 49 days out, medium being 50 to 89 days out, and long term being 90 to 180 days out. These are the three selections that you can make when you're using options play on Chaikin as to what is your preferred time frame when it comes to cover calls. So short term is for those of you that are very active with trading and looking to do short term calls, and long term is really for those of you that are long term buying and holders. Maybe you might only look at your account once a month or maybe once a quarter, and then medium is anywhere in between. So the question becomes, which one should you choose? And this is what we've been doing a lot of back testing on hundreds of stocks over about 10 years. We've been looking at hundreds of thousands of combinations of different strike prices and expirations. So we have a little bit to share with you today. And essentially, the selection is either should you trade short-term calls and, for example, 1 month calls and do them 12 times a year, or is it better off to do longer-term calls, let's say 3-month calls, and only do them 4 times a year? And the shorter dated calls obviously have less premium, but more certainty. What that means is that, if there's less time between now and expiration, you're more likely to know approximately where the stock may be headed within 1 month than it is for 3 months. And a lot of that comes down to earning cycles. So earning cycles usually throw a lot of uncertainty into where the stock might be. So that's why, based on our research, it's always better to be more on the shorter end of the spectrum and have more certainty. Even if that means you're taking in less premium every single month, you're better off selling 1 month calls 12 times throughout the year versus 3-month calls and only do them 4 times a year. And the reason for this actually is really, again, down to earnings. Because if you're selling 1 month calls and there's 4 earnings within a year, then only 25% of the calls that you're selling have a large amount of uncertainty. You want to have the least number of covered calls that you sell to have a lot of uncertainty. So when you're selling covered calls, doing that 1 month call gives you 25% of those calls to have uncertainty, versus if you're doing a longer dated call, like a 3 month call, then basically every single call that you sell will have an earnings cycle built into it, which increases your uncertainty. So that's why, based on our research, when you're selling covered calls, especially if you're interested in holding on to this stock long term, you're better off doing shorter dated calls versus longer dated calls, even though it means taking in less premium on each call that you're selling. So
And,
that's a little bit of information on expiration selections.
and Tony, based on the slide, it looks like I do have to get my PowerPoint skills upgraded. So let's move on to the next one, and I apologize for that.
No problem. So the next one is strike selection. So once you've picked your 1 month call options, what strike should you choose? This also has, you can go further out of the money, which gives you less premium, but it gives you more upside, or you can get closer to the money, which gives you more premium, but you have less upside available in your calls. And what we do is on the options play screen, you can select between conservative, optimal, or aggressive. Conservative is we're looking at about a 10 delta call. So these are calls that have about a 10% chance of the stock going above that strike price. 20 delta calls are optimal, which gives you about a 20% chance that the stock's going to get called away, or aggressive, which is 30 deltas, or about a 30% chance that stock will get called away. So based on our research, what we found is that because cover call strategies is a negatively skewed risk reward ratio, meaning the potential reward that you have on a covered call is limited to the premium that you're receiving on the call, but your downside risk is essentially unlimited because the stock can shoot way above that strike price, and you're going to be limiting your upside above that strike price. So because of that, the preference is actually, based on our back testing, is upside is more important than getting fat premiums. And from our back testing, we're showing that about a 15 delta call, or calls that have about a 15% chance that the stock's going to get called away, gives you the right balance between getting enough yield to justify selling covered calls, while still getting enough upside so that if the stock runs higher, you're not losing out on that upside on the underlying stock. So usually picking somewhere between optimal and conservative is where we think, where based on our back testing is showing giving you the best yield long term. So just to sum that up real quick, when it comes to finding the optimal cover call strike for selling cover calls to increase yield on your account, best thing to do is actually take certainty above premium. So meaning doing shorter dated calls where you have a pretty good idea that the stock's going to stay within a certain range. That's more important than getting large premiums by going further out. And when it comes to strike selection, upside return, making sure that you have some room for that stock to go higher, that upside return is more important than getting fat premiums by selling near the money calls. So, again, when it comes to expirations, short term, 20 to 45 days out is your optimal strike price, optimal expirations. And when it comes to strike prices, approximately that 15 delta call. So when you're on the options play screen, that's actually the default settings that we give you is the short term optimal. So even if you do nothing and you click on options for on the Chaikin Analytics platform and you click on income, we will by default give you short-term optimal calls as your starting point. You can make adjustments if you like, and if you want to get more aggressive, you can. So especially if you want to lose that stock, you want to get out of that stock, you can still choose that aggressive path. But for most of you that are interested in staying in that stock and generating some yield, your best bet is to be more on the short end of the spectrum and the optimal. And lastly, some of our research on which types of stocks work well with covered calls. This should not be too much of a surprise, but the best stocks is usually blue chip, low growth, high dividend stocks like GM, Blackstone, Citigroup, AT&T, and Walmart. These are the type of stocks that we've seen the best performance over different time periods, different volatility environments. These are the types of stocks that will perform long term. And some of the worst stocks are really the mega cap stocks that have high growth with low dividends like Apple, Bank of America, Facebook, Amazon, Priceline. These are the type of stocks that we see have the worst performance when it comes to cover calls. So just keep that in mind when you're scanning for your cover call candidates. The blue chip, high growth, low growth, high dividend stocks are usually best.
So let's look at an example here of a stock Textron where we had had a buy signal back in 2016 when we were coming up on a webinar with Tony at the end of the year. And where that yellow arrow is, we actually were recommending a covered call, assuming that you had bought it at some point in this consolidation after the breakout. And the stock was trading just under 50. And here's what we recommended. Actually, this was the second cycle on a options play webinar that we did in April. This was the second iteration. You could have done 3 or 4 of them. With the stock at 47.5, we used options play to come up with an optimal covered call strategy that we modified slightly and assume that you own 200 shares of stock. Textron pays very little dividends, so it doesn't really fit Tony's ideal criteria, but we were catering to people who might have bought Textron using Chaikin. It was suggesting that you write the May 19 calls, so about 5 weeks to go, right in Tony's sweet spot, yielding $112 per option or a 2.36% return, which annualizes out to 22.64%. Now let's assume that you had done a series of option writes on Textron, and now it's July, and what do? Well, you write another covered call. The stock is roughly the same as it was 3 months ago, 47.91. In this case, instead of the 49 options play recommended the 48 covered calls, but a higher return, 3.42%. Maybe you're getting tired of owning a stock that's going sideways, so you don't mind having it called away. 29% annualized return. So what are your thoughts on this screen here, Tony?
So this is exactly what you mean. This is where we roll. Texon has a relatively low dividend yield, but the annualized return on this cover call is so attractive. It certainly is going to be worth taking a look at, because if you hold on to this stock, you're getting paid close to nothing, and by adding a covered call, which really the whole point of this is to add yield to your account. This is one of the best ways to add yield on a stock that's paying no dividends. So this stock is, especially if it's a stock that you want to own long term, and the Chaikin Power Gauge is telling you this is a stock that may continue higher. This is certainly a stock that I would entertain taking a look at, just because the yield on this cover call is so high, and you want to do this month after month, because you're getting almost 2 to 3% monthly on the cover call, which annualizes out to 23 to 29% over the year.
And again, the reason we picked this back in, I guess, January was that we had been talking about Textron in our weekly market letter and assumed that people had bought it in the 45.6 area after that big spike up in the consolidation. Now let's look at how we screened for stocks that met Tony's criteria. Value stocks in this case, we used a value universe up here on our screener instead of the Russell 3000 with a bullish power gauge rating. Consistency of earnings is strong. That's another factor that we've back tested that yields good dividend and option writing strategy. It's consistency of earnings. It's not the big boomers that can also take big falls. And then I was looking at large and mid cap stocks with at least a 2% dividend yield. So I try to meet all of Tony's criteria using the Chaikin screener. And again, reduce 600 stock universe down to 20 candidates. And it's a variety of drug stocks and biotech, some retailing stocks like Best Buy, but we zeroed in a bank stock, KeyCorp and JP Morgan, which reports a week from Friday. Hopefully positive earnings surprise there. And we zeroed in on Bristol Myers because I think that pretty much encapsulates everything that you talked about based on your research, Tony. And why don't you take it over from here?
Yeah, so like what we look for is essentially, again, that short-term optimal strike, which is the strike that gives us as close to a And in this particular case, Bristol Myers Squibb is trading at 55. So what we're looking at is the August 25th, which expires about 50 days from now, right in that short-term range that we're looking for, and a 57 covered call. This is a stock that currently pays a 2.77% annualized yield. And as you can see, the annualized return on this covered call is 18%. So we're increasing your yield on owning the stock from about 3% to about 20, 21, 22%. So that's why adding these types of strategies is such an attractive strategy to your portfolio. And at the same time, it provides quite a bit of downside protection if you are concerned of a short-term pullback in the underlying stock. You know, getting another 2.5% on the underlying stock within 2 months is a great way to add some downside protection without having to go out and buy what could be very expensive puts. To get some downside protection.
So we're looking at the chart here on Bristol Myers, and it does have a bullish power gauge rating, which I obviously believe very strongly in, but it's been going sideways. This is sort of like buying a store, buying a building in a good location, knowing that you're going to get great rent on it. Think of the options premium and the dividend as the rent you're getting on the stock. Now, there may be a time when Bristol Myers breaks out to the upside if the drug group catches fire, but right now, based on all the research I've done over the years and what Tony's done, it's these stable stocks going sideways, paying good dividends. In this case, with the bullish power gauge rating, that's your directional edge. But a fabulous option writing strategy where if the stock just keeps going sideways, you make 22% on your money. Well, that's like owning a building with very high rents. You're renting out Bristol Myers to options buyers at a very cheap price. The worst that can happen on the upside, now obviously there's always downside risk in owning a stock, is that the stock gets called away from you at 57. So you bought it at 55, or maybe you bought it a cycle ago. Really attractive option writing candidate. Any further thoughts on that, Tony, or have we pretty much covered it?
No, I think you're pretty much good. I was just going to say on that Bristol Myers, if you chose the short-term optimal strike, I think it would have picked something closer to about 60. I think you had chosen the aggressive one. So I think depending on whether you're aggressive or conservative, it would pick somewhere between 57 and 60. So then that's based on how aggressive or conservative you'd like to get with your cover calls.
Interesting, and I do have the settings set on aggressive because I'm always looking for a high return, and I'm willing to take a little more risk on that. So let's talk about playing good defense, because good defense often leads to good offense, and this is pretty simple stuff. In addition to risk management and money management, cutting your losses and not putting too much into a trade. There's another aspect to playing good defense, and it's encapsulated in a quote by Herb Greenberg, who is back writing again and appearing on CNBC. For a couple of years, he was focusing on his short strategies for hedge fund business. But he said 2 years ago, in January of 2015, 14 actually, it's the stocks you don't own that matter. And by that he meant playing good defense is not about hitting the big winners, it's about avoiding the big losers. So you can reduce risk by avoiding mistakes, and that means avoiding stocks with a bearish power gauge rating, because they're the ones that are likely to up and bite you. You can reduce risk by avoiding weak industry groups, by knowing what stocks not to buy. Don't buy the Under Armours of the world or the energy stocks when they're in a bear market. Improve performance by eliminating potential losers from your portfolio. And then finally, with an options theme for today's webinar, use put options to protect your portfolio. All that is about playing good defense. So we often get the question, well, Chaikin has done very well for me in a bull market, but what's it going to do for me in a bear market? Well, this is what an idealized bear market looks like, and it was developed by a market technician named Richard Wyckoff over 90 years ago. And he theorized that this is what stocks look like when they go from a distribution phase, and maybe it's the semiconductors now or Tesla, and start to break down. And he also developed the same pattern on the upside. So my response to people was that even though we've been in an 8-year bull market, The energy sector actually went into a bear market in 2014 in late August and dropped in terms of the XLE, the Select Spider Sector Energy ETF. So these are the large cap energy stocks in the S&P 500, dropped 50% from 100 down to 50 in the course of about 16 months. That's a bear market. So how did Chaikin help you avoid the pain and make money? Well, look, you got a bearish personality change. You broke a long-term trend line here at around the 90 level. And when you looked at individual stocks in the energy sector like Kinder Morgan, the damage was even worse. Here's a stock that went from 42 all the way down to $12. A lot of people seduced by that 20% yield. A lot of financial advisors put clients into that willingly because the 20% yield was very compelling, but it doesn't do you any good when the stock's dropping 75%. And as you can see, the long-term downtrend persisted for an extended period of time. Here's what Kinder Morgan looked like on a one-year chart. That was a 5-year chart of both the XLE and Kinder Morgan. Well, this chart is from 2015 into early 2016, and you can see the patterns that we focused on early in the webinar. Power gauge rating and relative strength, both were bearish with the stock above 40. There's your dynamic duo in March of 2015. The institution started selling the stock. You got overbought sell signals on these new 8-day highs at 32 and 31, and then again at 23. And the stock was headed down to the 10-12 area. It's an example of how playing good defense, avoiding stocks like this, getting them out of your portfolio, looking for put buying opportunities can often lead to good offense. Now, what's energy doing today? Well, we all know the price of crude is dropping at $40 the other day. Goldman Sachs called it a bear market in crude with a lot lower prices coming. That marked the bottom in crude oil, which has bounced. Gave up a little of that today. So here's the XLE in real time. And again, a bearish personality change back in late January. The XLE was trading at about 72 on its way to 62 in a market that was making new all-time highs. You want to avoid these stocks. At the end of the webinar, we're going to give you a very special offer so that you can easily afford to have this information at your fingertips and benefit from moves like this on the downside. Now, here's an example of a stock that you might have found if you were looking at this kind of information. Schlumberger, the largest stock in the oil machinery service and drilling industry, provide equipment for oil drillers. Bearish power gauge rating, underperforming the market, institutional selling, and an overbought sell signal about a week ahead of a bearish earnings report. The stock was trading around 78 there in February, or rather in April, on its way to 65. Now, we happen to do a webinar with Tony on, I think it was April 11th, and we actually featured this Schlumberger bearish vertical put spread. Options play on April 11th recommended, if you were bearish on Schlumberger, which we were, based on the power gauge and the relative strength and the money flow, buying the 79.5 put, which was just a tad in the money, and selling the 74 put against it, expiring May 26th. So again, about 6 weeks to go. That's the ideal sweet spot for Schlumberger, risking $172 with the potential to make $370. So very, very big, better than 200% return. And by the time the expiration came around, the stock was trading at 72. So you realize that complete profit within 2 weeks. Now, as we're going to see later, we're going to look at some put buying opportunities or spread opportunities in Schlumberger because we're in earnings season. Volatility, as Tony said, very high during earnings season. A lot of uncertainty But if you're using the Chaikin power gauge as your GPS, you take away some of that uncertainty, because stocks with bearish power gauge ratings are twice as likely to report a negative earnings surprise. Stocks with bullish power gauge ratings almost twice as likely, based on our research, to report a positive earnings surprise. So there's a lot of speculation in the media, and it's really important to have something reliable to tell you whether a stock's likely to beat earnings estimates or disappoint. And then you can find winning options trades in options play. So here's an example of that in living color, happening as we speak. On April 9th, in our weekly market insights, we said stocks are marking time, waiting for earnings season to begin. Well, that's happening now again, just 3 months later. And we recommended 3 auto parts retailers to sell on strength: Advanced Auto Parts, AutoZone, and O'Reilly Auto. The group was weak, and these stocks were all at or near 52-week lows, again with the market at a 52-week high. We said to sell these weak retailers on rallies of 2 to 4% over the short term. So here's your example. We made Advanced Auto Parts our bearish stock of the week. You got that rally into the earnings report in May. Negative earnings surprise, overbought sell signal. That's that wonderful 2 to 4 week time window. I'm sorry, 5 to 10 day time window when that options trade really pays off big. But then look what happened yesterday. The auto parts stocks were down 10 to 20% in one day. So here's an example of how we help you find them. Again, knowing that there are opportunities is one thing. Knowing how to find them is what's really important. So for a webinar that we did in mid-May, we showed a backward look at our earnings reports, which are in our weekly market insights. And we were looking for O'Reilly Auto and Helmerich & Payne in that weak energy sector to report that week of 424. But we show you the power gauge, which tells you to expect a bearish earnings surprise. And then about a month later, just before the week of May 22nd, we were looking at a report from Advanced Auto Parts. As you'll see in a minute, O'Reilly had already reported a negative earnings surprise. That's why group strength is so important. And Best Buy with a bullish rating was due to report. So here's O'Reilly. This is where we wrote the market letter. This is that 3 to 4% rally, 2 to 4% rally. Bearish earnings surprise, the stock drops from 265 all the way to 235. It then rallies again magically to 250. Wall Street never seeks to amaze me. Great opportunity again to do a put spread. Drops again, gaps down to 228, rallies to 245. Third opportunity to sell. And then look what happened yesterday. The stock went from 218 all the way to 178. It was down 40 points yesterday, almost 20%. And down again today, another 1%. This is what happens when you use that magical formula of the dynamic duo, industry group weakness, some negative money flow, negative earnings surprises. You can make an awful lot of money in put options. Now, O'Reilly reports on July 26th. If you get a bounce in O'Reilly, and this time it may not bounce so quickly, our earnings indicator is telling us to expect a negative earnings surprise. Analysts are cutting their estimates for the second quarter. And today's, the price action of yesterday and today is bearing out something very negative happening in auto parts retailing. Now, we also zeroed in on Helmerich & Payne as a bearish stock. It's in the same business as Schlumberger. Bearish earnings surprise. Spike down in the stock, went from about 67 all the way to 49. And you could have ridden that trade. This was our overbought sell signal for 5 to 10 trading days, and taken a nice profit and beyond. Now, looking at those oil service stocks, Schlumberger and Helmerich & Payne, is there an opportunity using vertical put spreads to benefit from further weakness? So Tony, why don't you comment on what we're seeing here?
Yeah, so despite energy being well, energy is very weak, and these stocks are very weak. But the one thing to consider is the fact that taking bearish bets on these stocks are still relatively good on a risk to reward perspective, as you could see from the options play score of 128 and 116. So if you believe there is still more downside to these uh, energy stocks, which I think there very well could be. Energy is just starting, oil prices is just starting to stabilize, but a lot of these companies are not profitable at the prices that the price oil is at today. So we can continue to see potentially poor earnings on these stocks. And that's why I think the put spreads are a great way to potentially take some limited risk downside bets on energy to continue going lower.
And as you could see from that chart on Helmerich and Payne, they've just rallied between 6 and 10%. So that's normally a good time to initiate a put spread or buy a put option outright, which in this case doesn't have the same high probability. You want to do it on strength, not on weakness, which is why when we recommended selling the auto parts, we said don't sell them at the bottom of the page on these new 52-week lows. Wait for a rally. There's almost always a rally. There are optimists on Wall Street. There are a lot of different opinions, so you never have to jump on it. Wait for that ideal setup, the Warren Buffett setup. So we got this testimonial back in, again, 2016 from Mark W. A fast and efficient process. I had a 90% average return in my first 6 earnings trades using options play and earnings features. All very simple trades. Chaikin Analytics makes the process fast and efficient. So instead of getting bogged down in due diligence, I was trading. And in this case, Mark actually gave us his handwritten trading blotter showing the trades. One of them he lost money on, the other 5 trades made big returns, average gain 90%. So this has been working for years and years and years. It builds on work that Tony did in options play prior to founding it. It builds on work that I've been doing for 40 years, combining technical analysis, fundamentals, and options strategies. So we're going to end the webinar by showing you our newest innovation. In May, we participated in the Benziga FinTech Awards. I mentioned that earlier in the presentation. And we won the award for Best Trading Ideas Platform, beating out 19 other competitors. So what is the intellectual property that won us that award? It's called our stock discovery engine. In the same way that Netflix finds you movies, or Pandora or Spotify helps you find music that you're going to like, the stock discovery engine helps you find stocks that are similar to stocks that you're interested in. So in this case, I seeded the stock discovery engine with Bristol Myers just today. So I'm getting back stock ideas based on Bristol Myers, which has a bullish rating in the large cap drug group with a high dividend yield. So we saw that all on our buy right strategy. And it's giving me stocks in the drug group with similar characteristics, but it also shows me high dividend paying stocks in the drug group where I might want to initiate a buy right strategy, similar to what we showed you in Bristol Myers. Now, back in May, when we were aggressively bearish on the auto parts retailers, for a webinar I did on May 25th, I seeded the discovery engine with advanced auto parts. You see why on the previous charts. It came back with the suspects that you would have hoped to see, AutoZone and O'Reilly, which was 240 on the way to 180 and below. Macy's, other retailers like Target, but it also suggested potential swaps. So you want to avoid these or look for put buying opportunities on rallies. But if you wanted to stay in retailing, it was suggesting Best Buy as a potential swap out of Advanced Auto. And Best Buy was due to report earnings 2 days later. So I featured this on the webinar using a bullish vertical call spread. Here's what Best Buy looked like on that webinar. You had just had a buy signal, an oversold buy, new 8-day low. Dynamic Duo was in play. That's your directional edge. And the company was due to report earnings the next day. So on the webinar, we suggested, based on options play, a bullish call spread. This was on May 24th. Buying the 50 call, which was about $1.30 in the money, and selling the 57 call against it. Now, in this case, because this was an earnings play with earnings due out the next day, we went for the shortest duration spread possible, the June 2nd expiration. You paid $247. It was worth $1.30 because it was in the money. And it had all that potential, $700 potential, take away the $247 cost, profit potential of $453. That profit potential was realized the next day as the stock spiked up from 51.30 to 59. So you realize that profit in one day. Now, this doesn't happen every time, but when you're seeing returns like that, high returns of almost 200% in a day, you can afford to take some small losses or some bigger losses, knowing that you only have to be right 50% of the time to come out a big winner. And with the options play probability-based ideas and Chaikin analytics, your win rate should be higher than that. So let's end the webinar by looking at Tesla. I promised you we'd take a look at it because I think this is a bearish personality change happening right now. The stock was down even more today than the 5.6% that you see on the chart. It finished very weak. They're talking about it on CNBC. It broke our long-term support line. And notice that this is an example of relative strength standing alone and that high wire without a safety net. Starting in late December, Tesla broke out to the upside, was outperforming the market, but without the benefit of a bullish power gauge rating. And it had a big run, 220 all the way to 380. I was quoted a number of times saying, be careful, watch out, because the valuation on Tesla was $62 billion at the peak, bigger than General Motors and a couple of other auto stocks combined. And suddenly, the psychology has changed on Tesla. And I think that our relative strength, even though it looks back over 6 months, is going to go from green to red in the next day or two. So that's going to complete the picture. Bearish personality change. The power gauge will be bearish tomorrow. And it may just be that based on negative consumer reports, slackening demand for their current cars, and slower production on the new Model 3, that the jig is up in Tesla. And if it is, how do you play it from the downside? Well, here's a vertical put spread in Tesla that expires in September, on September 15th. So it gives you more than 2 months to see whether Tesla is in fact having a personality change, which may take it from, well, it was 312 when I did this slide. It traded around 308 at the low today, down over 6%. To see whether Tesla is in fact going to break down to the 280 area. Now, if you look on the chart, the recent low was 230, so 280 is not out of the question in a stock where everybody was long and the shorts got decimated, so there were very few people who could weather that move on the short side. So what happens if Tesla dropped to 280 by September 15th? Well, for $1,440, you can control $3,100 worth of stock on the short side, 100 shares. That's your absolute risk. Can't lose more than that. With the potential to see that spread widen out to $35, giving you a $1,700, I'm sorry, a $2,100, 150% potential. So if the stock drops about 12%, this vertical put spread will give you better than 10 times that, or roughly 150% profit potential. So that's how you can use options play and the Chaikin power gauge and relative strength to increase the aggressive side of your options trading. So we've showed you how to supercharge your options profits both aggressively and using covered call rights to generate income. And now we want to make it very, very affordable for you to take advantage of all these tools. Chaikin Analytics now includes our stock discovery engine, options play, the screener, earnings alerts, news, and intraday charts. So everything but your order entry pad on your online brokerage account. And in addition, we give you small group tutorials headed up by Joe Bicella and his onboarding customer success team to help you understand all the features in Chaikin Analytics and get up and running quickly. My colleague John Schlitz's daily morning insights and my weekly market letter, and you've seen examples of that with the auto parts stocks, with a bearish stock of the week or a bullish stock of the week. Now, Tom Gentile, who's an options trading guru, writes the options column for Technical Analysis of Stocks and Commodities magazine, says, gain the edge you need for trading success. As a rule-based trader in both stocks and options, he relies on quantitative analysis to give him an edge, and he saw the same orientation in Chaikin Analytics, delivering something that very few software tools do, superb charting, but proprietary algorithms not found in standard charting packages. So thank you, Tom, for this testimonial. Now, we've had an Independence Day special. Chaikin Analytics is normally $1,950 for an annual subscription, and we're going to extend our July 4th special, which reduced the price of Chaikin Analytics by $450 to $1,500 for an annual subscription. We're extending that through Sunday, July 9th, to give everybody on this webinar the opportunity to subscribe to Chaikin Analytics. Go to chaikinanalytics.com/options. Joe Bicella is putting that link up into the chat box, so you can click on it now. And we have an added bonus for you. For everybody who subscribes by Sunday, we're going to give you the ability to gift to a friend or a family member a 1-year subscription to our weekly Chaikin Market Insights. It's a $300 value. And think about what you can do for your spouse or your children or a friend to help them extend their market knowledge and invest and trade more profitably. In addition to your subscription for $1,500, you just have to call our customer success team and give them the email address of the person that you'd like to gift a free annual subscription, 1-year subscription to Chaikin Market Insights, which comes out every Sunday. They'll get the benefit of what you're getting as a subscriber to Chaikin in the Chaikin Market Insights with our industry group analysis and our weekly bullish or bearish stock of the week. They would have known about those auto parts stocks to avoid or trade on the short side if they're traders. So chaikinanalytics.com/options, or you can call 877-697-6783 if you have questions. I know there are a lot of questions that have come in. We had a lot of material to present, so I know Joe Bicella has been answering them along the way. If you had specific questions, anything about the offer, call that number, talk to one of our salespeople who are here standing by. So with that, I'd like to thank our partner, Tony Zhang, and not just for being on the webinar, but for building Options Play so that we can offer the highest probability, highest information, options, ideas capability to Chaikin Analytics subscribers.
Thank you, Mark. Thanks everyone for listening to what we have to say today. Very happy.
Yes, thank you, Tony. And with that, I'll turn it over to Joe Bicella to wrap up the webinar.
All right, everyone. Thank you all very much for taking advantage of today's webinar. As you can see from Mark's screen, and in fact, just to clarify that offer again, that's our July 4th special, $1,500 for a full year to Chaikin Analytics. This is one of the lowest offers that I've seen for a full year to Chaikin. So it's a fantastic offer. Tomorrow, we have one more webinar to host for our subscribers. That is our onboard session. That is the best way for anybody new to Chaikin Analytics to hit the ground running and get up to speed. We're going to show you how to create new watch lists, how you can find different candidates in the program, how to really understand our analytics here, so that as you set up a new covered call, any other kind of income strategy, you'll have a full understanding for what's taking place. But all of that starts first and foremost with the onboard session tomorrow. And we'd love to have you join us. And pairing this along with a really sharp discount for a full year to Chaikin Analytics, as well as the added bonus of market insights for a friend or a coworker or anybody else with interest in the market. I think this summer is going to be very interesting, and having reliable insights will be critical. So do a friend a favor as well as yourself by taking advantage of Mark's offer here. So with that said, everybody, again, you can reach us at 877-978-6257. Our support team's sticking around a little bit later tonight, so give us a call. I saw there were a few stock requests that come in. Take a live look with us. Give us a call. We'll be able to show you. But in the meantime, have a great evening. Keep an eye out for the recording tomorrow, and we will see you on tomorrow's onboard session. Thanks.